I've been asked to share my thought process when entering trades. So I wanted to make this video to share more of how I enter trades, what is my thought process, what are the things that I'm looking at when entering trades. So hopefully it's useful for you if you're trying to trade yourself. Because there are a couple things that I think are quite important to pay attention to when you enter trades. So hopefully at the end of this video, you know a bit more about my thought process when entering trades and you know what I like to look at and what you should pay attention to. But before diving into this video, if at any point you find this video interesting or helpful and you like to see more videos like this one where I share, for example, my thought processes on how I enter trades, then don't hesitate to subscribe to my channel and liking this video. That's the best support you can give me and I'd really appreciate it. So this video is going to be composed of several parts. At first, I'm going to describe the strategy that I like to follow. Then I'm going to talk about, for example, the factors to consider when entering trades. What are the advantages? What are the disadvantages of this type of strategy? So you can have really a full picture and you can not only see the good sides that I want to show, but also the bad sides, the negative sides, because every strategy is going to have its advantages, but also its disadvantages. And it's very important right off the bat to understand this. There is no 100% perfect strategy. Every time you're going to try something, there's going to be like, good sides of it and there's going to be bad sides of it. And if anyone tells you that there is a strategy where there's absolutely no downside, I can absolutely assure you that they're lying. Every time you use a strategy, either it's, selling naked options or it's buying options, it's buying leaps or it's selling credit spreads or whatever it is, there's always going to be some downsides to it. After that, it's about knowing what downsides you're actually fine with. For example, personally, I'm not necessarily fine with buying options because I tend to prefer to sell options. That's personally the way I'm comfortable trading. However, for some people, maybe they like to, for example, use certain strategy with a ton of risk and they don't mind about it. Well, that's fine, but you have first of all to understand that there is always a downside in any strategy that you're going to go for. There is never a strategy where there is going to be 100% winner or there is no downside to it. There is always going to be downsides to any strategy. And there are plenty of strategies that I personally like to use. For example, I love to use the wheel strategy, but I also like to use the poor man's covered call, and I also like to maintain an options portfolio using, for example, credit spreads. And that's on this options portfolio that I wanted to make this video on. I wanted to share with you what is my thought process when selling credit spreads, because this is really important to understand, I think, the philosophy behind it. Because the big problem is that I see usually is that it's very easy to check out what is a strategy about. For example, if you want to sell a credit spread, it's very easy to understand what is it about. However, what is the thought process? How do you actually use that strategy in real life? And what are the real life cases, examples on which you're going to use it? And that's this type of question that I really want to answer in this video, because usually you tend to see, here's how you're going to do credit spreads, you're going to sell an option, buy an option at a lower price, and that's it. However, there is not necessarily a lot of videos explaining the thought process behind it. And that's why I wanted to make this video, because I think it's important to understand in which type of condition I like personally to enter trades. So my thought process is the following when I enter trades. I very much like doing the opposite of what the trend is doing. And I know it can sound counterintuitive in a way, because it's like, if there is for example, a very big uptrend, why just not going with it? However, what I personally like to do is really take this contrarian approach. What do I mean by this? Well, taking a contrarian approach means that you're going to essentially bet against the trend. And doing this is going to allow you to benefit from, for example, a pullback if the trend stops and just reverses. In that case, you're going to be in a winning position. And on the contrary, you're going to be in a losing position if the trend just continues. And let me give you some examples so it's completely clear. So right now we are on the TestWorks platform and I've chosen the stock Apple, as you can see up here. So obviously when I said that, I like to take a contrarian approach, it really does mean everything and nothing at the same time. So I really want to show you some examples so you can fully understand what I mean by being a contrarian, because it can really mean a lot of things. So if we take the example of credit spreads, meaning that if you sell a put credit spreads, it means that you're bullish. If you sell a call credit spreads, it means that you're bearish. And what I mean by being a contrarian is that when a stock reaches the high end of its trading range, let's say for the past month or for the past 2 months, then I'm going to sell, for example, a call credit spread, meaning that when the stock arrives at the high end, I'm going to be bearish. For example, if I see that at the highest Apple has been trading around $142, if I see that, for example, Apple is coming back to this $142 level, then I'm going to be bearish. I'm going to bet that the stock is going to come back to a mean, to a certain mean. And on the opposite, if I see that, for example, over the last month, let's say that Apple has been trading at the lowest around the $120 per share. If I see that Apple is coming back to the $120 level, in that case, I'm going to sell a put credit spread, for example. I'm going to be bullish here. And my philosophy is really the following when I use this type of contrarian approach. Whenever, for me, a stock is trading at, for example, at the upper end of its trading range or at the lower end of its trading range, I really genuinely believe that the stock has more probability to come back to its mean rather than continuing the trend where it was. Hence why whenever the stock is at the low end of its trading range, I'm going to sell puts or put credit spreads, for example, because I'm going to bet that the stock is going to come back higher. And whenever the stock is trading at the higher end of its trading range, whenever the stock is trading at the upper end of its trading range, then I'm going to be bearish because I'm going to bet that the stock is going to come back to a mean, to a lower price. And of course, this has its great benefits and also disadvantages, meaning that if we are in a ranging market, this strategy is absolutely going to benefit me. However, if we're in a market, for example, in a crash or in a very strong uptrend, then I'm going to get hurt, of course. But that's exactly the downside of this strategy, and at the same time, in any strategy, you're going to risk something. And I want to give you a real life example on what I've been doing on United States Steel Corp from the ticker X. I mean, since the beginning of 2021, X has been ranging, as you can see. It went from, for example, $23 per share to $15 per share, and then it came back to 23, and then it went down to $19. I mean, you see that it's been ranging since the beginning of 2021. And now we're in my transaction history for the stock X, and what you can see here is that I've been trading X quite a lot, and actually I've exactly been doing this. Whenever X would reach, for example, the upper end of its trading range, I would sell a call, and whenever X would reach the lower end of its trading range, I would sell a put. And that's exactly what I did, and luckily for me, it worked out well. However, I'm 100% aware that, for example, if X had continued its trend, either uptrend or downtrend, I would have got hurt. However, that's the thing with this strategy. I like it because in a way, whenever the market is ranging, you're obviously going to earn money. And personally, it's been benefiting me a lot, especially since the beginning of 2021. And I think it's a great strategy so far. Because here's the thing also when you sell options, and that's also another advantage of selling options. Whenever you sell options, you don't necessarily need to have the stock moving a lot in your favor. If you sell an out the money option, then you don't need to have, for example, the stock moving a lot. You just need the stock to stay away from your strike enough at least, and you're going to have the time decay working for you, because every day that passes, options lose a tiny bit of value, and that's called the time decay. And when you sell options, the time decay is benefiting you, meaning that every day that is going to pass as an option seller, you're going to earn a tiny bit of money. And that's why when you sell options, you're not necessarily in a rush for being right. You just need to let the time go, and you're going to earn money just thanks to the time decay. That's why when you sell options, you are not necessarily in a rush for being right. The time decay is going to do already a lot of work, and that's honestly a very good way for me at least to trade. And some people have been asking me if I use any sort of technical analysis. When I say that, for example, I'm going to sell a call when the stock is at the higher end of its trading range, or for example a put when the stock is at the lower end of its trading range, do I use any type of technical analysis? Well, I don't personally. I don't use at all any type of technical analysis, but here's the thing. I don't necessarily believe that technical analysis is giving you any edge of any sort. That's really my opinion. However, before you put a dislike on this video because I don't like technical analysis, let me finish. If you feel that technical analysis is helping you make your decision-making process easier, if it's helping you and if it's making your life simpler, then I'd say fair enough if you want to use the technical analysis. I mean, if you want to use any sort of technical analysis so as to determine what is the higher end or lower end, you know, fair enough, who am I to judge? However, I don't necessarily think that this is going to give you any edge of any sort. This should be considered, I think, as a tool that is going to maybe help you make your decision-making process easier, but in no way this is going to determine if you're going to be right or wrong. And I know that plenty of people use technical analysis, and to be completely honest, like I've been also using it in the past, and I thought that there was maybe an edge, but the problem with technical analysis is that you fall very easily into what we call the confirmation bias. Because trading is based on probabilities, you are obviously going to be right sometimes, even though, you know, you have done some kind of analysis. That doesn't mean anything. And because you're right on some analysis doesn't mean that the analysis is going to be 100% right all of the time. This is only probabilities. Sometimes you're going to be right, sometimes you're going to be wrong. So as I said, knowing this, after that, if you want to use technical analysis so as to make your decision-making process easier, then, you know, fair enough, like who am I to judge? But personally, I don't use any type of technical technical analysis. The only thing that I personally use that helps me is just to look at where the stock has been trending in the past in terms of higher end and lower end, and that's just it. If the stock is now back, for example, at the lower end, I'm going to sell a put credit spread or a naked put. And I gotta mention that I have a tendency to be biased on the upside because the stock market tends to grind up way more than it goes down, meaning that on the long term, we know that the stock market is going to go probably higher and higher. Then when you sell put credit spreads or you sell naked puts, then you're obviously on the long term going to earn more money by selling puts because usually the stock market tends to go up. So obviously being bullish is obviously going to benefit you more than being bearish. However, before you go on and start selling put credit spreads and call credit spreads on the low end and high end, I want to mention some things that I think are very important. When I started trading like this, I thought that there was more to it than just, selling just the put credit spread when the stock is at the low end or call credit spread when the stock is at the high end. You also need to consider what are the positions that you already have on, and let me explain. For example, right now we are in my portfolio, all the positions that I have in terms of options. So all of those positions are actually risk defined positions, meaning that those positions that you see like XLF, GDX, Wells Fargo, Gap, KR, American Airlines, and Dropbox, all of those are credit spreads. But the thing is, I like to personally keep in mind the portfolio that I already have when looking for new positions. Let me give you an example so it's clear. If I want to have a portfolio of, let's say, 10 credit spreads, I'm going to ideally have 5 put credit spreads and 5 call credit spreads. The reason for that is that I want to have my portfolio that is delta neutral. Delta neutral basically just means that regardless of where the market is going to move, you're going to earn money. If you have a very bullish delta, if you have a big positive delta, it means that you're very bullish on the market. And if you have a big negative delta, it means that you're very bearish on the market. And having a delta neutral portfolio allows you to make money regardless of where the market is going to go. So that's something to keep in mind whenever you're going to enter a trade, because the situation that you don't necessarily want to find yourself into, and I know from experience, so I know how it feels, you don't want to find yourself in a position where you've been selling, let's say, 10 put credit spreads, and then the market starts going down. Because if you only have bullish positions and the stock market starts going against you, then you're going to be in a very bad situation because you only have bullish positions. So at least if you have managed to make your portfolio delta neutral, where you also have bearish positions, then in that case, you're not going to be in a very bad position if the market goes against you or if the market crashes, because at least you'll also have those bearish positions that are going to make you earn money, and you won't be in that much of a drawdown. That's why personally, I really force myself to keep some kind of delta neutrality in my whole portfolio. When we are in a very bullish market, for example, like we are in, for example, the SPY has been grinding up since, I don't know, November. I mean, it hasn't stopped climbing up and climbing up. Well, the problem in a bull market is that the stocks don't reach their low ends. If you look at most of the stocks in this market right now, most of the stocks are only going higher and higher. And that causes a problem in a way that I feel very uncomfortable selling, for example, put credit spreads when stocks are just going higher and higher, because it goes against a bit what I want to do. And let me show you an example on Gap. I've sold a put credit spread, I think, when the stock was around the $34 per share level. And as you can see, we're not at all in the low end of its trading range. I mean, you see that the stock has been going up and up from $19 to $35 now. And because the market is such in a strong bull market, it's very hard to find, at least for me, bullish positions, because the stock market is just going higher and higher. And there is no pullback so as to bring back the stocks at the lower end of their trading range. And so I have an opportunity to sell a put credit spread. And because I want to keep a delta neutral portfolio, I want to sell put credit spreads also. And it's very easy in this market, for example, to sell call credit spreads because the stock market is just going up and up. So in my philosophy, it's quite fine for that side. However, if I want to keep a delta neutral portfolio, I also need to sell put credit spreads so as to have bullish positions, which makes the thing kind of hard when you are in such a strong bull market where everything is going higher and higher. And that's really a good example, a good representation of what is going on in my head whenever I'm trading. It's very hard to be 100% confident when you are trading. So if you're not 100% confident, know that it's fine. I mean, I'm absolutely the same. I'm always second guessing what I'm doing. And you know that even though you know what are the strategies, you know how it works the Greeks, I mean, in real life, you're always always questioning your things, you always try to maintain a delta neutral portfolio. And in markets like this, it's really hard to maintain a delta neutral portfolio because you just don't have the opportunity to sell put credit spreads because the stock market is just going higher and higher. And following my philosophy of selling put credit spreads when stocks are at the low end of its trading range, well, it's kind of hard to do it now. But as you can see, for example, for Gap, I still force myself to sell put credit spreads and I still do it. It's not necessarily the best, but you gotta keep a delta neutral portfolio, so I still do it. But it's hard. Also, another factor to consider, which I think is very, very important, and that's directly linked to the fact that we are in a bull market, is the level of implied volatility. And what I mean by this is that the lower the implied volatility across the whole stock market, the lower the premiums, meaning that the less money I'm going to make as an option seller. And one very quick way of seeing this, if you look at, for example, the VIX, which is the implied volatility for the S&P 500, you can see how low is the VIX right now. I mean, it's around 17, when for the whole 2020, well, it was around like, I think 20 or 30. I mean, it was amazing. Basically, the higher the stock market goes, the lower the implied volatility overall, meaning that the lower the premiums, meaning that the less money I'm going to make as an option seller. And honestly, that's really annoying, but that's just how it is. I mean, that's why I really want to see a pullback quite soon, so we can first see an opportunity to sell put credit spreads when stocks are at the low end of its trading range, and second, we can see an increase in the implied volatility, and so seeing premiums get more expensive, and so having potentially making more money here. So you can see that it's not as straightforward and as easy as it might seem. I mean, obviously, it's very nice, you have all those strategies, but you can see that it's always you never 100% figure it out. Well, at least personally, I don't think I will ever figure out at 100%. I'm making money, however, it's really a hard game. So to sum it up, my thought process is the following. When the stocks is at the low end of its trading range, I like to sell put credit spreads. And when stocks are at the high end of their trading range, then in that case, I'm going to sell call credit spreads. But as I said, there are several factors to take into account. How many trades do you already have on? How many bullish trades, how many bearish trades do you already have on? Try to maybe keep a delta neutral portfolio, so wherever the stock market is going to go, you're still going to make money. And also, is the risk worth taking when you have very low premiums? Meaning that if you are only going to make few bucks on a trade, is that trade really worth taking? And that's really the two factors that I really personally consider when entering trades, when, going through all that thought process, all of those things, I try to basically put them together and then make a decision on that. So you see that it's not at all a straightforward process, and that's really for me what trading is. There is not like a thing that you're going to follow and just bang it and just make millions. I mean, it's not that easy, unfortunately. And that's why it's also important, in my opinion, to keep a portfolio of stocks, because when the stock market is going to go up and up like it is right now, if you have a stock portfolio, then in that case your stock portfolio is going to appreciate in value. And that's exactly what I have. When the market is going up, I have my stock portfolio that is appreciating in value, and that's really nice. And when the stock market is going to go down, then premiums are going to get more expensive. In that case, options are going to make more money, and that's going to be more profitable, and my stock portfolio will lose value, but at least my options will make a lot more. So you see with this video that when we just put my thought process on paper, meaning that selling put credit spreads when stocks are at the low end of its trading range and vice versa, I mean, it's very simple to understand. However, it really gets hard when you get into real life examples, because this is just not something that is as straightforward as it might seem. There's plenty of factors to take into account, and it's really not an easy game, and it shouldn't be an easy game. That's why most of the people are losing at this game. But I hope that this video will have brought you maybe some knowledge, some information, and it will have been helpful for your own trading. If it's been helpful and you found this video interesting, then don't hesitate to subscribe to my channel and liking this video. As I said, it's really the best support you can give me, and I'd really appreciate it. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.